Hello and welcome. Thank you so much. You're watching the Business Today show with me, Chaiti Narula. Let's begin with the top stories first. Markets up for the third straight day, fired by banking results. Sensex crosses into 60,000 territory again. Nifty up 119 points. Does the Sensex break out over 60,000 mean a turn in market sentiment? Catch a very special conversation between Udayan Mukherjee and market guru Sandeep Tandon later in the show. EMI is all set to fall again. Yes Bank MD and CEO Prashant Kumar tell BTTV in an exclusive conversation that interest rates have peaked and will fall again by the end of the year. Uber luxury brand LVMH sets a new record in Europe, becomes the first continental company to cross $500 billion in market cap. Founder Bernard Arnault cements his position as the world's richest man. Maruti launches its 14th car in India, prices the Fronx crossover at 7.5 lakh rupees, takes the SUV challenge to Tata, Hyundai and Kia. Sundar Pichai, the CEO of Alphabet, has been awarded a whopping $226 million as compensation in 2022. While most of it is stock award, the decision has still come in with a huge criticism, with the company having announced big layoffs in January. Meanwhile, in India, the average CEO salary is seen rising just over 6% this year.
Apple CEO Tim Cook was a distant second with a $99 million pay packet for 2022. The other Indian origin CEO, Satya Nadella, took in $55 million. Facebook founding CEO Mark Zuckerberg was at the fourth position with $27 million. He reportedly received just $1 as salary and rest as perks, likely travel, security and other costs. Andy Jassy of Amazon earned just $1.3 million in 2022. Pichai's pay package has come in for huge criticism, with netizens slamming Google for paying its CEO this amount just months after it laid off 11,000 employees. Commentators also targeted the nearly $6 million a year spent on his perks, as well as the massive difference in salaries between Pichai and the median IT worker. Meanwhile, in stark contrast, CEO compensation in India is expected to moderate considerably this year. A Deloitte survey of 6 major industries takes the weak macroeconomic environment into consideration. According to the survey, the average CEO compensation will rise 6.25% this year to 11.9 crore rupees. While that for CXOs is likely to stay the same at around 3.2 crore rupees. The survey further differentiates between promoter CEOs, whose average salary is likely to dip 4% this year to 13.45 crore rupees, and professional CEOs whose salaries are seen rising by 14%. What's also on the rise is the surveillance on the performance of top officials of companies. With the worsening economic climate making work environment more challenging, the top officials have their work cut out for them. Bureau Report, Business Today Television.
Stock markets extended the gains for the third straight session as benchmark indices settle higher today. Buying in banking and financial counters pushed the indices higher, taking Sensex beyond 60,000 mark after 7 sessions. Also, earnings of behemoths like ICICI Bank and Reliance Industries supported the market sentiment. The Sensex was up 401 points, while Nifty gained 119 points. The top Nifty gainers were HDFC Life, Tata Consumer, Wipro, Axis Bank and ICICI Bank. The top index laggards were Dr. Reddy's, IndusInd Bank, Cipla, Divi's Lab and Maruti Suzuki. Does the Sensex regaining 60,000 level indicate a change in the market mood that has been a little subdued of late? India Today's Group Global Business Editor Udayan Mukherjee earlier spoke to market guru Sandeep Tandon, founder and CIO of Quant Money Managers, about what lies ahead. And here is an excerpt.
Now, for somebody who keeps an eye on risk so closely, what do you make of the India VIX right now? You know, May last year, I think it was at 26, 27. Now it's languishing at 12. Does it worry you as an investor or a fund manager that the India volatility levels have fallen to such low levels?
So then it's an interesting question. I will put this perspective. See, a lot of people have just started looking at VIX, and a lot of people look at VIX in isolation. Okay, the way we explain the phenomena is that overall derivative volumes have declined significantly. People, the market participant, have hardly any exposure left in the leverage market. In this background, the importance of leverage data also comes down significantly. Let's say give you some more example. Okay, when Bitcoin was in a right from 2015 onwards or 2012 onwards, we have seen some new animal which known as the cryptos came to the market. But if you look at in last 1 year particularly, okay, money flow towards crypto as an asset classes has come down significantly. And earlier we used to look at crypto data or the cryptocurrencies data as a risk appetite indicator for the young generation or for certain countries. Now, if overall volumes has come down significantly, and hence this concept of risk appetite for young generation has been lost. So it's very important to understand the contribution it is making. Let's say one more example I'll give you, crude. Okay, today is still very, very important, but the relevance of crude has declined over a period of last 10 years as compared to natural gas, and now maybe in future it will get declined further because the renewables are coming. So it's also very important to understand what role that particular asset classes or stock or sector is playing in the overall perspective. If overall volumes of the, let's say, Indian derivative market has come down, and its relevance is also declined. But the low walls or sticky walls which VIX is showcasing right now, it also showcases some signs of vulnerability at some point in time. Okay, if some global events unfolds, okay, it has the probability that VIX can also spike. So we have to look at from both perspective. One, if just looking at the VIX, can you get all the answer? Answer is no, because the selling which happened in the market was predominantly the ETF-led selling. Okay, the passive fund selling which was there and which has no impact on the VIX as or the derivative market as a whole. So that's the reason we can say the relevance of VIX has declined in today's context. But you cannot ignore it also completely. As I said, it's a low walls also means a sticky walls, and if some events unfold, it can spike significantly.
How are you characterizing this current up move in the market, Sandeep? I mean, does it strike you as a relief rally because people have become too pessimistic, or is this the start of a new trend?
So yes, people were very pessimistic. If you really look at a month back or last few months data, in generally people are tired. People have given up. There's hardly any interest. Even if you look at from the market momentum point of view, when you look at it, has become a largely institution player versus real retail. So the in between the layers of the family office or ultra HNIs or HNI or real retail player who was participating in the market, their participation has gone down significantly. And then if you really, if I have to quantify in terms of quant fear index, okay, it was in some of the stock it was as high as pre-COVID level, and in some of the names it has spiked, and that's the reason we have seen this sort of sharp recovery which is happening, because nobody wants to participate in this rally. And market was very light. So the impact cost, then if I have to put it statically, the impact cost in the market has gone up significantly. So market has fallen with low volume, and similarly market has rallied also with low volume because the impact cost is very meaningful.
So to come back to my question, are you still characterizing this as a relief rally, or do you think it can take the market back to that old high?
So if you really ask me the way, then we don't analyze in this manner. Yes, there could be some sort of pause. Maybe if this rally momentum continues, like a lot of people are looking at 17,800 as a important level. If it breaks, then 18,200. We don't look at the market in this manner. The way we manage our money is that any given time we play or try to generate alpha through sector rotation or stock rotation. Okay, because we are traditionally a long accounts mandate which we have. Because if you really ask me, yes, 2023 I have been talking about, this is the culmination of a volatility expansion phase. We have been talking about right from 2018 till 2023. This is the volatility expansion phase, which means the employed vols of the global asset class will remain elevated, and this is the peak year of that. And when we say this is the peak and the final year for that, typically the employed volume spike further at the peak of the cycle. That's the reason we say that it can only spike with some event which can unfold. But you also keep in mind, if this is the culmination of that phase which is getting over, it means any dip which can come for any global events used to be buying opportunity, because Indian macros are far superior. I don't think in last 30 years of my career we have seen all good data points are there. So very, very compelling case for a long-term investor. So we remain very constructive buy on dip strategy. We like to play through this route, and the sector rotation really help us. So we are not trying to time the market, trying to say whether this is a breakout zone or it can correct further. The way we are looking at, yes, we are still in risk of environment.
And you can watch the entire exclusive show on our social media, on YouTube, Business Today, and our website, businesstoday.in. The past 1 year saw an unprecedented interest rate hike of 250 basis points by the Reserve Bank of India. This made life extremely difficult for the borrowers, who saw their EMIs spike to unmanageable levels. But there could be some big relief on the anvil, as Business Today TV Managing Editor Siddharth Ravi found in this exclusive conversation with Yes Bank MD and CEO Prashant Kumar. And here's an excerpt and slice of that conversation.
On the broader point of our interest rate environment and inflation, what's your own reading? There is, of course, the guidance and commentary that we have got from the MPC, but your own view on how inflation as well as the interest rate scenario is likely to pan out over the next 4 quarters.
I think for our country, it's always like a trade-off between the inflation and seeing the growth. Okay, so I think in this trade-off, at least I would be seeing that after increasing the rate of interest by 250 basis points, okay, inflation also, and whatever we do now, the impact on the inflation has a lag effect. It takes almost 6 months actually to having that kind of impact. So I think if all other say parameters in terms of monsoon, in terms of crude oil prices, or in terms of international events, if there are no major surprises, I would be saying this rate of interest to remain stable in this range and then start coming down.
Mr. Kumar, could you also explain to our viewers the outlook as far as credit offtake is concerned in the current financial year? We've seen that interest rates have hardened. You also had to pass on the cost, and overall macroeconomic environment is very clear to everyone. What do you see happening as far as credit demand is concerned?
I think now rate of interest has almost peaked out. Okay. We have seen like last policy, Reserve Bank has not increased the repo rate. And the expectation is also like after remaining stable at this level, it actually would start coming down, maybe by the end of the year. Okay. But despite like rate of interest going up, we have not seen any slowdown in the credit demand. Even like if you see the RBI numbers, even during April, there has been a good credit growth from all the banks. So I think we are seeing, and this is exactly reflected in our numbers also. On the retail side, our growth is 38%. MSME growth is also 22%, and mid-market has grown by 36%. But overall, like for us, it is around 13%, because there has been a run down on our corporate book, again as a strategy, okay, which has actually degrown by 25%.
Okay.
But going forward, we would be looking definitely overall loan growth between 15 to 20%. Because we are at 15 to 20, between 15 to 20, where retail would continue to grow 30% plus.
And would that mean that the rate of degrowth of the corporate book will continue at the same pace, or you think it will stabilize?
I think it has already peaked out. It has already peaked out. Going forward, it would be either flattish or it would be growing in a small number, but it would not come down.
How is deposit growth panning out, Mr. Kumar?
For deposit growth, it's a struggle for everybody, but I think we have seen very, very good efforts from our teams on this side. Though our deposit end of period growth is around 11%, But our average deposit growth, I'm talking of average numbers, monthly averages, has actually gone up by 16%. And similarly, our CASA deposit, average CASA deposit has grown by 26%, and average current account has grown by 30%, which actually brings the advantage on the cost of our deposit. Okay. So today, current account is 15% of our deposit, which is a non-interest bearing. So I think we would continue to make efforts in both these directions. But I think in the current scenario where there has been a huge fight on the deposit side, we have been able to grow very decently on both CASA growth and current account growth. And now the differential between fixed deposit rate of our bank as compared to best in the class has come down significantly.
Okay. On an aside on that point, we've seen a recent trend where tech companies are now getting into some sort of banking activity and also offering much higher rate of interest. That, of course, is overseas, Mr. Kumar. But let's say by the end of the year, what would you tell the average saver who still prefers fixed deposits in India versus other kinds of investment, that what can he expect at the end of the year on his fixed deposit?
I think last year it was a clear-cut preference for the bank fixed deposit. Okay. And I think this would continue for some time. I think in the current year also, the bank would continue to offer a reasonable good rate of interest on the fixed deposit. So at least I would be saying, as far as safety is concerned and the returns are concerned, I think the fixed deposit of the banks would be a very, very attractive proposition for the investors.
LVMH, the conglomerate specializing in some of the biggest global luxury brands, has set a milestone in the European capital markets. The group has become the first in Europe to have a market value of more than $500 billion. The achievement comes less than 2 weeks after LVMH joined the ranks of world's 10 biggest companies. The rise in the share price of the company has also skyrocketed. Bernard, the man who built the global powerhouse, into the world's richest man with a net worth of $212 billion. The surge in the company's value is driven by a boom in the sales of luxury goods in China and a stronger euro. LVMH is home to brands such as Louis Vuitton, Moet & Chandon, Christian Dior, Givenchy, Kenzo, Tiffany and Bulgari. More than 3 months after it was first unveiled at the Auto Expo, Maruti has finally launched the Fronx crossover. The Baleno-based hatchback has been priced between 7.5 lakh rupees and 13.14 lakh rupees. The car is available with 2 engine options, a 1.2-litre petrol, 90 bhp engine, which is standard on several other Maruti cars. Also an offer is a 1-litre turbo petrol engine with 100 bhp output. All models have a manual and an auto option. The car is going to be pitted against the likes of Tata Nexon, Hyundai Venue, Kia Sonet and other mini SUVs. As a part of Maruti's shifting focus to SUVs, the Fronx is expected to be shortly followed by Jimny 4x4. Well, that's it from me, Chetty Narula, on the Business Today show. Continue watching India Today and don't forget to log on to indiatoday.in or go ahead and download our app. Thank you so much for tuning in. Thanks for your time. Wishing you a very good night.